I think people tend to use quant and systematic fairly synonymously. And what we mean by either is really a process whereby the day-to-day trading decisions are delegated to a predetermined rule rather than every single trade being thought through by a human being. And this approach, at least to my mind, has two distinct advantages over a more traditional discretionary approach. First of all, by being systematic, you can create a sort of inherent diversification by taking human biases out of the investment process. I think another advantage of quant is it allows for greater scalability. A lot of quantitative strategies rely on exploiting a small edge which you want to repeat many, many times, be that across many markets or multiple times through time. Quant traders are sort of thinking at a slightly higher level in terms of sort of building, researching and refining the models that are themselves going to make those trading decisions. So our decision making is really about how we build the models and then how we allocate to those models once they're active. When you go and look at the data, you just don't see that. It's just not there in the data at all. Given the way quants trade, especially things like trend following, there's no way systematic strategies are going to be affecting S&P futures. They're just too small a part of the market. But there are parts that it could affect. So if you look at small futures markets, I mean, things like orange juice that is diversifying, it's logistically easier to trade. Quants tend to love markets like that. Those are the places that you would go and look for crowding. And again, there we don't see the signs of crowding anymore in those small niche markets than we do in the big markets. I think something we have found is the markets that tend to get crowded tend to be the ones quants like to trade, so specifically equities and the vanilla futures markets. Once you move away from these to emerging markets, to swaps, to mortgages, credit, some of the more esoteric commodities like iron ore, carbon emissions, things like that, quants tend to be less active in these markets. There's perhaps a slightly more healthy ecosystem where, if you take the example of commodities, they're more dominated by producers and consumers than systematic traders. And that's meant, on the one hand, diversification of these markets has remained high. But on the other hand, perhaps there is a little bit more alpha to exploit as quants there, playing in a space where there are less quants operating. So managed futures, I think, is a really good example of the benefits of a systematic approach. So for our purposes, managed futures really means trend following. And it is as simple as this chart would have you believe. Essentially, you buy stuff if it's going up and you sell stuff if it's going down. The skill is very much in the implementation. So what type of trends do you target? How do you scale in and out of those trends? What's the universe of assets you cover? And so on. Trends has a number of really appealing properties, specifically diversification. And when you talk about human biases and systematic being able to overcome these biases, trends is a great example in that there's a very common human bias to cut winning positions and to cut winning positions too soon and take profit. And a trend following strategy with the appropriate controls is able to stay in those trends that go on longer and further than perhaps most people would expect. But I think perhaps even more important is it has extremely valuable defensive properties. And this means it tends to perform well in stressed environments when volatility is going up, typically when equity markets are selling off. It's been very good around some of the most recent crises, particularly the GFC in 2008.